For more on how the markets are reacting today, let us bring in LeBas, Chief Fixed Income Strategist at Janney Montgomery Scott. Guy's ranked as one of Bloomberg's most accurate economic forecasters. He joins us now from Philadelphia. Guy, welcome back to Bottom Line. Always good to have you on.
Thanks, Mark.
Guy, the irony is that today's market downturn comes a day after we observe that second anniversary of the bull market lows. Are investors too impatient?
Well, I think investors have realized a pretty hefty return, particularly in the equity markets over the course of the last 6 to 18 months or so. And I think there's good reason for many of these investors to be cautious about what happens going forward. There are major questions on U.S. economic growth, and obviously the unrest in the Middle East that appears to be spreading, well, that's another risk factor that just kind of adds to an already heavy load.
Well, Guy, even with today's numbers, we're seeing job creation pick up. Is that a cause for optimism, or are you cautious given geopolitical concerns overseas? We're hearing that news out of Saudi Arabia today, not to mention that ongoing housing situation here in the U.S.
Well, one of the problems with higher oil prices, which is primarily, at least for the U.S. economy, what the effect of Middle East unrest seems to be having, is that it encourages firms to spend on other things other than hiring. With your input costs as a firm rising, you need to be that much more certain about your future prospects before you're willing to hire a worker. So this increase in oil prices could slow the pace of job growth in the U.S. It's hard to say exactly how much, but that's a major, major challenge in the future.
And interestingly enough, too, because that rise in oil prices, we're seeing that rise in commodity prices in food and in gas at the pump. How much are those higher prices going to impact our economic recovery?
So we tend to do things in terms of price of oil because that's one of the more variable, one of the more volatile components. But we estimate that each $5 that a barrel of oil increases in price takes about 0.2 to 0.3% off of U.S. economic growth per year. And that means about 0.2 to 0.3% for the unemployment rate, give or take. So it's not meaningless by any means. Also, if you take a look at this morning's trade balance numbers, higher food prices are having an effect on how much we import, which is also problematic.
Well, Guy, I was going to mention, too, because I've been asking some of our other guests as well, when we look at some of these economic numbers, especially when we look at the price of oil and how much it's been costing for people, at least in the past week, 10 days, to fill up the tank, what is that going to mean for consumers? Again, as I asked a guest earlier, what's that going to mean for the consumers as we head into the summer driving season?
Well, it's a major factor. Really, if you look at the short-term impact of higher oil prices, it's kind of like a tax. Consumers can't alter the behavior in the very, very short term. They can't drive shorter distance to work, so they need to cut back in other areas. And that's what really concerns us. What other areas are consumers going to cut back to afford higher gas prices in the short term? There's no good answer. We suspect it's going to be on durable goods purchases, an area of the economy that's already been pretty well depressed for a couple of years now.
Guy, if we might take a look at overseas, we saw European and Asian stocks down earlier today after that weaker than expected Chinese economic data. Is this an aberration because January and February trade data are lumped together to take into account that week-long Lunar New Year holiday?
Well, it's very hard to say. The Chinese exports data, of course, has a lot of the one-time items built in, as you mentioned, because of that holiday. At the same time, we're seeing a gradual rise in the yuan, the Chinese currency, against our major trading partners. That's partly by design of the Chinese government. But this is also having the effect of altering their exports and reducing economic growth within the country. So I think that's a small piece of a long-term trend. Now, when we talk about long-term, we're talking about something that's going to play out over probably 5 to 10 years, not a couple of months or even a couple of years.
Well, then can we expect a strong return to surplus in China in the coming months?
I would expect so. I would expect the Chinese export volumes to maintain relatively strong for the intermediate term, particularly as developed economies around the world remain relatively stable and are purchasing those Chinese exports.
Guy, in our last 30 seconds, is this still a buying opportunity for investors, even given these mixed signals and mixed numbers that we're seeing?
Well, I think there's a lot of uncertainty going on in the world, particularly when it comes to the U.S. stock market. However, the fundamental U.S. outlook is generally upbeat. We're actually a little bit more optimistic on the fundamentals than we have been in some time right now. So that's one positive sign to think about.
All right, Guy LeBas, Chief Fixed Income Strategist, Janney Montgomery Scott, joining us from Philadelphia. Guy, always good to have you on. Thanks so much.
Thank you, Mark.